I'll start with some bear arguments, then go to bull arguments. We'll have some charts. I'll make some brief predictions and then some general strategy ideas for people listening that are worried about protecting their wealth. So let's just jump in quickly. Let's go to the bear arguments. I've been listening to the bears for about 5 years, maybe 4 years. I've been bullish most of the time. I guess you could say I'm listening to them a little bit more carefully now as we go higher with a lot of asset prices. So most asset classes are at or near all-time highs. We've had almost everything hit an all-time high, right? We've had gold hit 5,000, Bitcoin hit 126,000, tech stocks hit all-time highs last year, or in let's say January. We had the S&P 500 continually hitting all-time highs, and we're there right now. So everything's kind of hitting there. Semiconductor stocks have gone off 10x in the last year and a half, the memory stocks, etc. So, you hear the bears saying we can't go up forever. That's true. We've seen very bubble-like behavior in terms of very big sell-offs, and the Korean Kospi index sold off 10% in one day. And there's two stocks are the majority of the index. So we've had a lot of these, semiconductors now 18% of the S&P, where it was probably less than 5% last year. So we're seeing a lot of ups and downs, a lot of rotation, a lot of frothy behavior. Number two, the bears are saying continually that the US consumer is weak and we're still going to get a recession. They point to inflation being persistent. Oil prices hit $120 during the Iran war. So this chart, it's the S&P. There's a similar one to the NASDAQ that I think is the Buffett one, but it's just showing the prices on the S&P in ratio to the GDP in the US, right? And so this is going really, really high. I've been hearing about the Buffett indicator for a couple of years as well, and why stocks are overpriced historically, and that Buffett has a huge cash position and all that. I was listening to a trader the other day. Look, he believes the AI move is real. The innovation is real. It's not hype. But US GDP only grew 3% last year, right? Sales predictions for these AI tech companies does not match a 3% GDP, okay? And I think that's what you're seeing here, is that prices are outstripping GDP. And this is legit, right? And so he's basically saying that eventually either GDP needs to rise or these sales predictions are not going to be true. Because at the end of the day, you need an end user consumer, right? You need a US citizen or someone to buy the product. And that's where this chart is a little bit more than just a chart, right? Knowing the why behind the chart is obviously really critical. And so I started to think about that, and I do think that's a legitimate argument. Mm-hmm. So I think it's a good argument. The bears also just say that AI is overhyped altogether. I don't agree with that, but they might be right about that. However, let's look at the next half of this chart. I'm going to go over some previous bear arguments that I've listened to very patiently that have been false, okay? So this is going back to COVID 2020. Right after COVID, we had an inflation scare, right? We had inflation go to like 8 or 9%. And we were told that was going to crash the stock market. We also had real estate crash predictions with all of those flames, the flames on the thumbnails, disaster. And that because inflation was rising, they were going to raise interest rates, which they did. And this was going to cause real estate to crash. And if real estate crashes, you're going to have a 2008 crisis, right? So that hasn't happened. We had the Ukraine-Russia war get very bad, and the idea was that there was going to be some spillover into Western Europe or draw in other countries. There were some sell-offs, but it's been contained for the most part. In 2025, we had the Trump tariffs. Apparently, it was going to end world trade and that we were going to have a massive recession. There was a sell-off, but it didn't stop the bull market. Last year, Mag 7 over-concentration was a big one. The idea was that the Mag 7 was the majority of the gains in the S&P, and that's why prices were going so high, is because these 7 companies, including NVIDIA, were carrying it. That's no longer true, and I'll show some charts later that most of the fast-moving software companies have sold off, and semiconductors taken that mantle. This year we had the Iran war in February, and the Strait of Hormuz closure, which is controlling the world's oil supply. I didn't think this would happen, to be honest, Dave. I thought this was not going to happen, but it did. So kind of a very small probability event in favor of the bears actually did happen. The worst case scenario, it still did not really phase the stock market. And then finally, SpaceX IPO. This was a couple weeks ago. The idea was there's going to be all this new supply of IPOs, and people will have to sell other stocks to buy this, and that this would crash the stock market. So none of these have damaged the bull run. They've caused pullbacks, but they've not been permanent. So
for the 7th point, I have drawn here a question mark, because this is something we don't yet know, because the SpaceX IPO has just rolled, and it's not yet today. It's not yet even included in the Nasdaq 100. It will be included in a week. So this is
sure. It's going to be phased in, and then you've got Anthropic coming, another IPO, Anthropic.
Yeah, I will talk about it a lot. Yeah.
So I'm just saying that up to today, let's not talk. But again, but you can see I've got at least 7, and there's probably another 10 here I missed, right? Were the bear headlines, and they've all been wrong. Now, they weren't wrong that these weren't issues. They all happened, and certainly we will get a recession, and we will get a crash. And the bears will be right. It's just we don't know when. Let's jump ahead because we're close for time. We're tight for time.
Yes,
so bull arguments, and I'll let the secret out. I'm mostly bullish again today. I do think I'm less bullish than I was because everything's just more expensive. But I'm still bullish on net in the short term, medium term. So short term, let's say 3 months, I'm bullish. 6 months, probably bullish. As we stretch out, let's say 6 to 18 months. I mean, nobody knows, right? Nobody knows. But let's just stay in the short term. This is just reiterating what I just said. This is since 2018. We're now June 2026. We've had 4 major pullbacks and several smaller ones, but we had COVID in February of 2020. That was a 33% drop. We had a legitimate inflation bear market in October 2022, January to October. We had an 8-month recession to some extent and a 25% crash. As recently as last April of 2025, we had almost a 20% crash for the tariffs, and then we had 9% in February. So we've had major pullbacks. This has not been a parabolic move, all in one move. There's been pullbacks, right? And you can see we're at all-time highs.
So statistically, 10 to 15% correction happens once a year over the past 100 years. Yeah. And you can see also from your chart that basically we don't have one since Q1 25. Basically, this was 10 to 15% correction the last time. So we still miss one. We are due for one, I think.
A 10% this year because we only had 9. Yep. It's possible. I don't think a 10% is a disaster, and it's definitely not a recession, or it's not it's healthy.
No,
it's arguably healthy, right? So I'm just showing here of how the bull run is very healthy. It's higher highs and higher lows, right? It's classic chart, and there was some major sell-offs. So it's not like the bears can say, well, not everyone's just in heaven. It's a perma bull, and they've never had any pain. We've had a lot of pain, right? So let's look at this. So this is again monthly, okay? And you hear, it's a 2000 crisis, or it's a 2008 crisis. If we just remove the economics and just look at the technicals, this is monthly. Do you notice anything about the two charts that are similar?
About these two crashes?
Yeah, within the bubbles, what are you seeing there?
It was like a double top, like they basically went to the same line, and then this was a giant M, basically, and then that M undertook this midpoint, which basically happens when the M is completed. And once they have taken this liquidity, basically it's the liquidity here, that was enough. And actually that was when the bull market
Look at the topping though, because I think your listeners are saying, have we topped? Have we topped, right? So look at the topping process. Like you said, there's a double top, but look at how many months it took as well. So look at 2000. It was 1, 2, 3, 4, 5, 6, 7 months before it rounded off, right?
Yeah, so it was a gradual. It was not a like V top,
Yes,
but it was
yes.
a saucer. It was kind of a
Yeah.
saucer topping kind
And
of.
those are monthly closes. So that's a
Yes.
7 month topping, right? Not
Hmm.
weekly, that's monthly. And then look at 2008.
It
One,
was
two, three,
also
four, five. Again, 7 months to top.
there was actually if you look closely, there is a little like kind of a double top, kind of an M
Yeah,
at the top of it. So
sure.
basically, and the one is
Yeah.
actually here as well.
Okay. Now jump back to where we are today. It's totally different. It's nothing to do with those two. In terms of a purely monthly close, um, I'm
Hmm.
not a technical guy, but I think it's useful. This is from Silvaco Capital talking about, and I think Crowded Market Report
Hmm.
too, is you don't want to try to short this before it's not showing it to you, right? So we're actually touching on all-time highs, and we've basically, like Jason Shapiro talks about, the market will tell you when we're topping, right? It'll show a failed retest, and if it's the S&P, it's probably going to be on monthly charts, not on weekly or daily. So again, for your listeners, if you're looking to say we might have topped, I think you would want 3 or 4 months where it does not hit a new all-time high, right? It tests it or it sits there. In the previous two, it was 7 months before it crashed, right? So very premature to say we've topped here. And if you're a technical, I would look at a monthly close of 2 or 3 months below all-time highs that try to reach it and close below it, at least before you see that. So, anyways, definitely as of June today, we're at
Hmm.
7,400. So we're just 1%, 1.5% below all-time highs. So technicals look good. Okay, now the other one, and I showed you all these tech companies that sold off. I sent you a copy of a tweet. Again, can you jump to that other one? So look at what's sold off. So if we're saying we're at we're at all-time highs, but not in tech stocks. They've all sold off. Coinbase is down 69%, Oracle 57%, ServiceNow. Look at this, bloodbath.
Okay, I have
So we
a
go.
yeah. I would like to mention that some of these are software companies like ServiceNow,
Well, they
Salesforce.
all are. Yeah, they're
They're
all software.
software companies, well, Netflix basically, but software is in a position where it's justifiably suffering. It's justified that it's suffering broadly because the AI is completely disrupting all of these monetization models of all the software companies because now the AI can do it in many cases even better for almost free. And also new software companies, thanks to the AI programming that now anyone, even me and you, Curtis, we can go and create our own app in 2 hours time today
So we'll
if we
see.
want to. And
That's the fear. That's the fear that AI is going to disrupt them. They're currently extremely profitable. Like Palantir
Mhm.
was up 80% year on year, and it still has sold off, right? So let's see. But my point here is not whether this is justified or not, Dave. It's that we've already had sell-offs. So if you're saying we're topping, well, gold already sold off. Bitcoin's already in a bear market. Crypto's in a bear market, 50% down. All the Mag 7 is sold off. Software companies have sold off. So the only thing maybe in a bubble is semiconductor, right?
overall hardware, not just semiconductors,
Yeah.
memories, most of all, even more than semiconductors is memory companies, but then also some cooling companies, some photonics, some
Yeah. But they're
other
only
chips,
18%, right? So
Intel, AMD.
yeah. So in a bubble blow off top, all of these I think would be, or a lot of
Now,
more of these would be at all-time highs, right? In my
these are more
opinion.
in a bear market already. Yes, that's
Yeah.
true.
So, and the Russell 2000 is up 20% this year, which is like the 2000. So it's a very broad-based movement now, is
Mhm.
why S&P is at 7,500. So we're seeing what the bears said was not happening, right? We're seeing it being spread out across a lot of different asset classes. Number three, corporate profits way up. So we had a massive beat on Q1 corporate profits. It was
Mhm.
up 21% year on year. Okay. And that's a big reason why we're at all-time highs in the S&P. Okay, that's corporate profits after tax. And so if you put that chart, Dave, next to the Buffett indicator, you almost see, okay, well, maybe that's why.
Mhm.
Like that's why the Buffett, maybe that
Mhm.
the
Mhm.
companies are just more profitable. That's why they have higher PEs. That's why people are
Mhm.
buying them. Um, and if profits were falling, the Buffett chart would look very, very scary. But because it's a mitigating factor that's very significant, profits are skyrocketing. Inflation, so
Mm-hmm.
oil was going to destroy the world. It hit 120. We're down under 70 now. So
Mm-hmm.
we've gone in just what, 3 weeks, 4 weeks, we've gone from 100 down to 70 or from 90 down to 70.
Yes, but
I
there
think
I
it
have to
was,
say that there is a known lag, which is actually about 6 months. So it's actually now, exactly now, these months, July, August, when the lag should basically hit the kind of economy.
well, you're saying it's going to get embedded into inflation. Yeah, yeah, yeah.
Yes, yes, and there is a lag. Yes, like
Yes, but oil prices are way down. That my
they
point
are
is, right?
down, but they were up for a couple of months, and I think
Yes,
the
yes.
true
So
impact.
there'll be a trailing impact. I get your point. Yeah, yeah, yeah. But remember, stocks are forward looking. So the
Mm,
sell-off was when the price spiked, and then we pulled back. Unemployment rate 4.3%. People keep saying they lie about the jobs. Okay, they lie about the
mm,
jobs. Okay, geopolitical risks. So this is something I've thought about a lot.
mm-hmm,
But I've always been quite pro-Trump, and my idea is that the moves he's making geopolitically are also good. A lot of people disagree with me, but so overall, Russia, Ukraine hasn't spread. Iran has been kind of pretty much put to bed. Their military's wiped out. Venezuela, they took out Maduro. China's been quite docile. So I think geopolitical risks are much lower than when Trump came into power this second term.
mm-hmm.
Chinese allies 5 years ago were Russia, Iran, Venezuela, maybe India, South Africa, a few other trading partners. But basically, Iran and Russia were major allies of China. They're both somewhat damaged now, which I think takes China power down. And I think overall geopolitical risks are down, and the market is pricing this, and this is good for business. I went over number seven comparisons to 2000, 2008. They're not accurate. I
Mm-hmm.
think the AI boom is real. The
Mm-hmm.
capex spending is enormous. Number nine is credit risk. There's a chart there I
Mm-hmm.
sent you. It shows high yield, the
Yeah.
spread between high yield and risk free. So
Mm-hmm.
for non-technical people, the difference between the safe U.S. Treasury and a high-risk bond like a Venezuelan bond or Egyptian bond, the spread is very low, which means bond traders are saying there's very little risk that they will default. So bond traders are saying um, this risky debt is not that risky in the short term because, and therefore we're not willing to pay that much more for it, you see?
We are at the
Uh,
bottom, basically. This is the
yeah,
line where we always
yeah.
come, bounce from it.
And you can see the spikes were the tariff and the war, and probably
Mhm.
before that was inflation 2023. I don't know what happened there, but all those spikes are some of the events we've been talking about. Now you can say, well, it's going to go up from here, maybe, maybe not. It might just go along the bottom. But as we stand in I'm talking about a 3-month window, bond traders are saying that risks are very low. And I think this fits, there's a reason for this, right? Like I said,
Okay.
geopolitical risks are lower. Um, and it does seem like global trade is smooth at the moment. So short-term predictions, yeah, I think I'm bullish the next few months. Look at the S&P going to maybe 8,000.
By end
Now
of
it looks like that's going to be carried by non-Mag 7 companies. If
Mhm.
Mag 7 starts booming, we're really going to get there. Like we can get
Mhm.
to 8,000 just with the Russell 2000 or like the other 493 companies in the S&P. But we'll still get drawdowns. Semiconductor
Mhm.
might sell off. There could be a crash. Uh, Looking at Bitcoin could bottom 48 to 58K, totally possible, or it could surge. Um,
Mhm.
Now, dangers to watch for is I think watch that the rounding of the top of the S&P. I think if you get a couple months where we're not hitting new all-time highs, I think that's a risk signal.
Mhm.
Or we just go parabolic again. Like you said, we haven't had a 10% this year. We had about a 9. But if
Yeah.
we go straight up from here all through the summer, end of year, maybe that's the blow off top. Pullbacks are healthy. It reduces margin, it clears the shorts and the longs. right? The volatility clears the market. It's a good thing. It's less likely we're in a bubble if we're getting major sell-offs that get bought. So the small crashes are very, very healthy. What you
Mhm.
don't want to have is long period of time where we go straight up, right? Now, medium term, I really don't know, 6 to 18 months. Of course, as we go higher and higher, it's more likely that we've topped. I would say look at US housing prices because this is a core wealth pillar of American homeowners. In other words, their house equity is a major part of their retirement their nest egg, right? And if US housing was to turn over, I would become very bearish very quickly. Canada, we finally had a crash, and
Mhm.
you can see that people are now not seeing real estate as a good investment. So it's quite interesting. They're in the stock market only now because real estate is no longer attractive. So I think if that happened in the US, where real estate went down 15, 20% in major urban centers, I would get very bearish very quickly. Just
Strategies.
strategies. If it's possible, you want to keep some cash, 3 to 4 years of
Mhm.
living expenses if you can afford that, just so you can ride out a crash. Typically, a bear market is maybe a year, maybe a year and a half,
Mhm.
and it usually recovers relatively quickly. So if you've got 3 to 4 years of cash, you can relax. Number two, having a diversified portfolio. So diversification is not just by asset class, right? Real estate, gold, stocks, bonds,
Mhm.
cash, but also by currency, it's useful. So if you're not in the US dollar, you can have the US dollar as a hedge against your native currency, right? In 2008, the US dollar became extremely strong versus every other currency. So it was a nice mitigator of declines, right? So owning US dollars alone is like for me, the Japanese yen has been quite weak the last few years. It's great because my assets are in US dollars. So I've had about a 30%, 25% support just from holding US dollars versus JPY or holding Bitcoin versus JPY. It's been great. And then another one by geography. So if you're wealthy enough to have assets in more than one country, it's a good idea, right? The other one is to own scarce, desirable assets that can't be printed. So for me, it's gold, Bitcoin. High demand real estate is real estate that's in areas where rich people want to own it, right? So city centers or view properties or high demand areas. Yeah, bet on the win. If you're nervous, go with some big cap tech companies with not bad PEs and just sit with them, right? Number four, you got to understand your time horizon. If you're thinking 10 years out, you can relax a lot more than if you need to buy something in 2 years, right? Number five, K economy will continue. This means that the rich are getting richer, the poor are getting poorer, but this will continue and there will be rich people that want to own assets. They're going to want to own real estate and stocks and gold and crypto. Owning that stuff before they buy it off you is the way to get wealthy. You buy Bitcoin before someone else wants to own it. You buy the condo in New York before someone else buys it. So the good stuff will still be in high demand, and it's very likely that this accelerates. Number six, low or zero leverage. Yeah, watch your leverage. And if you've got no leverage, you're probably going to sleep at night. So it's not for gambling, it's for investing. Number seven, in 2008, I was actively in the market. I was trading. Everything crashed, including gold. Everything sold off. There was no safe haven in 2008.
Mhm.
The only thing safe was US dollars, US treasuries. That's it. Nothing else, including gold. Yeah, so that's all I got for today.
I would like to thank you again for this amazing conversation we've just had and the presentation. Some of the really great ideas you've brought, and I'm looking forward for the next one, Curtis.
Okay, thanks, Dave.